Good morning from London. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Washington's tariffs continue to roil markets. Donald Trump pauses levies on Canadian and Mexican goods that comply with the North American trade deal. Sentiment fades with Asian stocks and European futures sliding on the uncertainty. While the Nasdaq nears correction territory, today's market focused the US jobs report. Plus, Bloomberg learns the US wants to link a minerals deal with a quick ceasefire between Kyiv and Moscow. Ukraine's president says he'll speak with US officials in Saudi Arabia next week.
Anna, the tariff U-turns are front and centre, as you said. European futures, they're not liking this uncertainty. You saw a similar picture, as you mentioned, in terms of the Asian market reaction. European futures called sharply lower after ending the session flat yesterday, pointed lower by 1%. Nasdaq 100 futures stateside looking to gain 0.2% in the context that they dropped 2.8% yesterday. Bitcoin at 88,000, the executive order disappointing crypto investors. US taxpayers are not going to be buying Bitcoin. 1.8% is the drop there. Euro dollar at 108. The strength continues for the single currency up 0.3%. The countdown to the opening trade starts right now.
I'm not even looking at the market because long term, the United States will be very strong with what's happening here. This is something that we have to do. There'll always be a little short-term interruption. I don't think it's going to be big.
He's not looking at the market, but the market's definitely looking at him, trying to figure out what is going to happen next. It has been an incredible week. We have been whipsawed by the administration in Washington. Our heads are spinning. It is hard to manage risk. It is hard to warehouse risk. It is hard to figure out where we are going next. That was a week. That felt like a month.
Yeah, it absolutely did.
And we're not done. Payrolls still to come.
7th of March. We still have a full trading day ahead of us for this 7th of March. But such volatility, incredible volatility. We've seen that in stocks in the last 6 days. We're actually, in the last 6 days, we've seen the S&P move more than 1%, back-to-back sessions. That's the most times we've seen that happen since 2000. Yeah. And that was also Trump-related because that was around the 2000 election. But what was also interesting is we didn't really see an uptick in sentiment. There was a bit of volatility, but no real uptick in sentiment when we saw that relaxation of some of the tariffs that comply with USMCA against Canada and Mexico. So it seems as if the market, yes, has been really volatile, but also a little wary of jumping on all of the headlines.
What does Trump want? Does he want to raise tax revenue? Does he want to crack down on fentanyl? Does he want to rewire the trade that is built out across the global economy? Or does he want leaders to come and beg and bow down and kiss the ring? I mean, what does he want is the question.
So I think Bessent provided some answers yesterday. I think Bessent's appearance in front of the Economic Club of New York yesterday, speaking directly to Wall Street, some really big Wall Street names in the audience for that event, moderated by Larry Kudlow. This was basically the Treasury Secretary speaking directly to Wall Street, trying to deliver the message. And I thought the messages were really interesting. The American dream does not equal cheap goods, i.e. inflation's coming. We're not worried about raising prices here. That is not what we should be thinking about. He says that those that retaliate, i.e. think about Canada, should expect an even worse treatment coming out of the White House in terms of the tariff story. Tariffs are his favourite word, the president, but reciprocal is his second favourite word, i.e. April the 2nd reciprocal tariffs are going to... That's the big one we're waiting for. And basically, he's talking about the revenue coming from tariffs being substantial. He's talking about the fact that it's going to fund tax cuts on tips, auto loans, all kinds of things. It's not regressive. The poorest elements of US society is going to benefit from the tariff story. These are really big messages he's delivering here to Wall Street about what is coming and what the nature of this administration is going to look like.
Big structural changes, and he continues to give us insights then into the thinking in the White House. Interesting then that they put so much emphasis on the 10-year yield, or at least on yields, and bringing those down because of inflation. If they were prepared to let inflation go, how would they square all of that? And I know there are a lot of people spend a lot of time, the Macro Man blog, for example, trying to join the dots between all of these signals.
When we think about inflation, we've got to talk about grocery prices. Then you have to talk about eggs. I have a cracking idea.
Excellent.
The US needs to import, yes, really.
That was a better joke, by the way. The excellent was a better joke than the cracking.
I'm not even joking. The US needs to import 70 to 100 million eggs within a month. Guess who produces a lot of eggs? France, Poland. Is this leverage for Europe? Grocery price, this is a disaster, President Trump has said.
Excellent leverage. Take us to the American breakfast.
But inflation takes us to the story. The question about whether or not US exceptionalism is being killed off by President Trump. Part of that conceptualism, of course, has come from what's happening in AI. So we had earnings from Broadcom. They have suggested that the AI demand is still there. So pre-market, Broadcom performing very well.
It's up 12, 13, 14% going into the session this morning.
The CEO talking about our hyperscaler partners continuing to invest aggressively. So that's the Broadcom story. But the broader story is, of course, that the Nasdaq 100 is near correction territory. Mag 7 is in correction territory. The divergence now between the performance of US tech versus China tech, and there's a basket that SocGen have put together called the 7 Titans of Tech in China that includes Alibaba and Tencent and JD.com. That basket has outperformed significantly. It's up about 40%. How long does that theme have to run?
The trade data out of China was pretty weak this morning. The Chinese-US trade war is still clearly going to be forced at a very aggressive level. Are we getting over our skis here? I guess the starting point is important to kind of quote the old Irish joke. You need to figure out where Chinese tech is starting from a really cheap valuation story. US tech is coming from a very high valuation story. I think that's the kind of the backdrop to all of this. But how much further can it go after a kind of initial knee-jerk reaction?
Something that started from a pretty, well, relative to history, high price in recent days is Bitcoin. As we're talking about things that are vaguely tech-related, where are we now? 88,134 is where we trade on Bitcoin. And actually it dropped as much as 5% overnight, but now down just by 1.9% on my screen. Trump signing an executive order, but it doesn't sound as if he's ready to sanction Elon Musk or anybody else to go around buying any Bitcoin on behalf of the government. They're just going to put into the strategic reserve, at least initially, the stuff they already have, the stuff they've seized.
But does that stop a real panic in crypto? I.e., does the existence now of this reserve stabilise the crypto market and stop it dropping? Because some people are talking about potentially a kind of really big crater here. Does the mere existence of this now stop that happening? I think is a question that some people...
The rhetoric is still very constructive on Bitcoin in terms of what you hear from the Trump administration longer term, in terms of what they're doing at the SEC, what they're doing in terms of revamping regulation.
And we'll be speaking...
That remains a story.
And we'll be speaking to the White House crypto czar later on in programming on Bloomberg TV.
Can't wait. It's going to be good. Looking forward to that a little bit later on. Let's talk about what's happening in Europe. Lots of solidarity on show yesterday. Europe's trying to figure out what happens next. And there's a definite whiff of panic in the air, isn't there? We're talking about 26 of the 27 nations signing the declaration. Hungary's clearly a problem. We'll park that one for the time being. But there is a clear effort now to carve out defence from existing fiscal constraints. That looks like it is going to gain traction. The Germans have started it. Other people are going to clearly go along with it. But Europe is waking up. I was listening to some of the commentary yesterday coming out of this summit. Europe is clearly waking up to a really difficult environment. You withdraw the security blanket that the US provides, Europe is really vulnerable. And the cost and the social impact of all of this is just starting to become clear.
Yeah, we have an incredible big take story out this morning talking to military officials around Europe about just how many weeks that Europe could hold off any kind of invasion without the United States. It's important to make that point in the assumptions. But yeah, fascinating conversations. Orban, as you say, standing aside. One of the things, and taking us back to Bessent, actually, one of the things that stood out to me yesterday, because a lot of we're busy dealing with a lot of tectonic plates shifting and a lot of realignment of geopolitics shifting in ways that's really unpredictable. And yet, through all of that, Scott Bessent saying they're prepared to increase sanctions on Russia if that is something that would enable this peace deal to be signed, some kind of ceasefire to be signed. So just another thing that made me sit up and wake up yesterday as to some of the detail that we're missing with this fire hose of news.
But that is one of the first times, and the reason you've zeroed in on it, presumably, is one of the first times where you heard about the Trump administration putting pressure, or at least threatening to put pressure, on Moscow. Because so far the pressure has all been one way, and that's been on Ukraine. Coming up at 7:30 a.m. UK time on that story, Oliver Kluck will be speaking exclusively with the European Commissioner for Defence and Space, Andreas Kubilius. So stay tuned for that interview, 7:30.
We've got plenty of other interviews coming up. There's lots to discuss. We need to talk about the credit markets. We need to talk about what's happening in FX, what's happening with the dollar. Omotunde Lawal, Barings EMEA Corporate Credit Head, is going to be joining us. European credit still super tight. Amelie Derumbe, Amundi Multi-Asset Strategies Head, is going to be joining us as well. Laurent Van Billon, Allstring Global Investments Rates and FX Portfolio Manager, joining us a little bit later. Kelly Chen, NATO Innovation Fund Partner, joining us. What is the vehicle that Europe needs to use to figure out how it incorporates new technology onto the battlefield? we're going to be having that conversation a little bit later on.
OK, here's what else you need to be thinking about as you work through your Friday. 10 a.m. UK time, Eurozone GDP. So another gauge in terms of the health of the European economy. Maybe that story will start to change on the back of this fiscal stimulus that is expected on defence. 1:30 p.m. UK time, of course, it's the big one on the data front. US non-farm payrolls data. Estimates of 160,000, jobless rate at 4%. 5:30 p.m. UK time. The Fed's Jerome Powell will be speaking. Who has a more challenging job right now? Is it Christine Lagarde or is it Jay Powell?
Jay Powell. I think the challenge for Lagarde is going to be enormous, but the uncertainty surrounding Jay Powell at the moment is huge. Actually, I think they've both got pretty tough jobs.
Yes, both very tough jobs. Is there any sense of relaxation, though, given that a lot of the news agenda, at least, is being driven elsewhere, and they're sort of price takers on the news?
They are,
aren't they?
But the potential for a mistake at this point
has
got to be huge. So payrolls,
yes.
160 is the survey number, which feels really high, considering that actually the whisper number is 120, and Bloomberg Economics has got a number of 65.
Yes.
Wow.
So if the market, I think, is positioned for a weak number, but how weak could it be?
Yes, but then interestingly, Bloomberg Economics not suggesting that is because the Doge layoffs and tariff threats really kick in yet. They think that maybe that takes another month or so, maybe March is when we see the effect of those. But it's to do with the education sector and bad weather, snow, that kind of thing, that they're saying that this February reading could be particularly weak. And
the Challenger survey yesterday, part of that was job cuts around the federal government, but part of that was as well technology and retail. And announcements around. So you've had Disney announcing they're cutting jobs. Some of the big manufacturers around semiconductors cutting jobs as well. That is not looking pretty.
As we were talking about rolling back tariffs earlier, worth noting also that President Trump has called on various cabinet secretaries to use, quote, a scalpel, not a hatchet, to make staff cuts. And this is being taken as a suggestion that maybe all the heat that was created by a lot of the Doge activity and all the cuts that were proposed there and the legal action, legal pushback that created, maybe a slight change of playbook.
Who knows?
Who knows?
It's really
hard to tell. It's 11 minutes past 7.
Tens of thousands,
that's what I'm saying now.
Tens of thousands of federal workers have already lost their jobs. I mean, they're not just proposed, right? So tens of thousands already.
The Fed is indicating that 80 to 100 is stability. So that's the kind of payroll number. If you go below that, you're starting. That's a real impact. That's a negative.
Does that pull forward rate cuts then?
So I think the end live question this morning is who's going to cut more this year, the Fed or the ECB? Back to your question about kind of who has got the toughest job right now.
Yeah. What else do we need to keep on our radar this morning?
There's plenty of it. The news flow continues. The Chancellor of the Exchequer here in the UK, Rachel Reeves, says she will reform the UK's welfare system as part of a government drive to find savings and plug a hole in the public finances. Speaking on a Sky News podcast, she said the system is, quote, letting down taxpayers because it's costing too much. Reeves is weighing cuts as she tries to make the sums add up ahead of her spring statement, which is on March the 26th. Think about the defence story and fold that into that narrative as well. SpaceX has lost its second Starship rocket in less than 2 months. The rocket span out of control before appearing to break apart during its 8th test flight. The rocket separated as planned, but the spacecraft began tumbling and lost contact with mission control around 8 minutes into the flight. CEO Elon Musk posted on X calling it a mishap and a minor setback, saying the next ship will be ready in 4 to 6 weeks. Bloomberg has also learned that Goldman Sachs is pushing some managers to move from more expensive office locations to cheaper ones. Dubbed informally Project Voyage, the plan aims to drive costs down and tap the pipeline of talent emerging in cheaper regions. The bank's Dallas hub has already grown into one of the largest operations in the world, while staffing at the New York headquarters has stagnated. Other growing Goldman Sachs locations include Birmingham, in the Black Country, the Midlands.
Yeah, that's the British version.
Yeah, Bengaluru in India. There's Salt Lake City in there as well, which at least has good skiing.
That, by the way, is not Birmingham on the screen.
What was that? I missed that.
That was probably Dallas, I think.
Salt Lake City has good skiing. Dallas has pretty... I've been to Dallas.
Taxes.
Yes, pretty nice food too. I mean, lots of it.
But who can beat the Birmingham Balti?
No, that's true. I think it wins. I liked how you went to Project Voyage. I'd read it as Project Voyage, which makes it sound a whole lot more...
that tells us a lot about...
Very sophisticated,
doesn't it? A lot about you, doesn't it? Yeah.
I'm not sure
Project Voyage to Birmingham.
How Goldman Sachs had intended it, yeah.
Yeah. Anyway.
That's a good one.
Cricket ground. Good cricket ground in Birmingham as well. What's it called?
Edgbaston.
Edgbaston. There you go. You got Edgbaston. You got the Balti.
Yeah.
You got some historic buildings.
I was born near Birmingham, so all good things come from Birmingham.
Can you do a bit of Black Country?
Let's not go there.
No. My grandparents made me tour around various kind of Black Country kind of museums and various things like that.
We're going to get the accent out of you by the end of the show. Guy Johnson's accent.
We'll record it for public interest. Right, coming up on the programme, the ECB cuts again, but heads for a slowdown for its next decision. We will report from Frankfurt. Lizzie Burden on the ground for us there. Plus, Universal Music Group reports a revenue beat for subscriptions. That's part of our stocks to watch segment later. Up next, this week's big data point. We'll preview the US jobs report. We'll discuss markets. We've got to talk about credit markets this morning. We'll do that shortly. We will be thrilled to hear from you if you want to write to us. IB plus BBTV Go.
In regional accents, please.
Yeah, absolutely. Any accents welcome. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
One thing we don't talk about a lot, and I think we're going to, is the tariff income. Right now we have substantial tariff income from China that President Biden left on. And if we have new tariff income, we won't be able to score that since it won't go through the legislative process. But I could tell you that could be very substantial.
That could be very substantial. That's a real shift from Treasury Secretary Scott Bessent. Last year, he talked about the fact that the tariff gun would be loaded and on the table but not used. Now he's talking about substantial income being generated by tariffs, which could potentially be used to fund tax cuts for the poorest half of America. That is a massive shift in terms of his use of and thoughts around the tariff policy. Just kind of speaks to the idea that we're in a new paradigm, that the ground has shifted significantly under us. Wall Street's trying to figure out, the world's trying to figure out how to deal with this. It's been a crazy week. Valerie's here with just how crazy it's been. And we're not done yet, Valerie. Payrolls to come.
We're not done yet. The big data print out later this afternoon at 1:30 p.m. London time. The equity market is on a back foot headed into this big print. S&P headed for its third straight weekly loss guide, down some 3.5% on the week so far. But take a look at what's been going on in the Mag 7, those high beta tech indices, slumping even more. Something that caught my eye in the next chart is that the Mag 7 index has slid below its 200-day moving average for the first time in 2 years. The market is begging out for some good news from this NFP print later today. The headline number is estimated to come at 160K. The unemployment rate to stay steady at 4.0%. There has been a lot of attention recently on the federal layoffs, those layoffs in the public sphere. Just when will they feed in to a possible weak payroll print? Will we get it this month, or do we have to wait for Q2? That's the question on the market's mind.
Barry, thank you very much indeed. Let's carry on the conversation around what is happening in these markets. Credit's a really interesting space, isn't it? Omotunde Lawal, head of EMEA Corporate Credit and Emerging Market Corporate Debt at Barings, joining us around the table. How was your week?
It's been a manic week.
Yeah.
I think.
So where are we? How far have we travelled?
So we were just talking about that quote from Lenin, right? There are
Yeah.
decades when nothing happens, and then there are weeks when decades happen. I think this is one of those weeks. Yeah, I think we were quite whipsawed this week when we saw how much bunds moved. Was it Wednesday? It was 30 bips, biggest move, and so it was like, what are we doing? What's the implication? And then we have tariffs on Mexico, no tariffs on Mexico. Is it on? Is it off? Is China retaliating? China not retaliating? Zelensky, Ukraine. I mean, so much this week.
The list goes on and on. What I'm really surprised about is the credit. I think we can pull up a chart. Still super tight. Like, really tight still. Can you explain that to me? The one asset that doesn't seem to be reacting at the moment is credit.
Yeah, well, you've seen, yes, it's still optically at tight levels, but you're starting to see a little bit of a correction coming through. Generically, what we're thinking is as the paradigm shifted, right? We came into the start of this year, we were thinking, okay, US would get better growth, Europe slightly softer growth, and therefore you were thinking US versus Europe, how do you look at it? And you were looking at spread levels. Actually now, post this week, where we've seen that shift coming through from Germany and the Eurozone area in terms of defense spending, that actually switches everything around, because now you're thinking the outlook for growth in Europe should actually be stronger and firmer, and you're getting more sort of stimulus to the GDP, potential GDP growth from that defense spending. So that should actually be positive for credit and corporates. So it doesn't matter that optically your spreads are where they are. Your all-in yields are still attractive because actually rates will be high in Europe to accommodate for that.
So I was going to ask you if corporates were going to be some sort of haven then in amongst all of this sovereign turmoil. But from what you've said, Tunde, haven's not quite the right word, because, you know, if it's about a stronger growth story, then you don't necessarily need a haven, but it's a place that might benefit.
It's a place that will benefit for sure. I think we're very constructive on the investment grade segment of the market. We think those are the companies, a lot of the companies that we're talking about, the defense companies, engineering, manufacturing, the guys who will produce goods that will make these defense weapons and all these things, construction, those kind of companies, largely investment grade, those should benefit from it. Where you have some concern, or maybe where you want to be more nuanced, is what the impact of higher terminal rates in Europe now means for some of the slightly lower rated credits, and maybe REITs and real estate and things like that, those kind of sectors that rely on lower rates. But certainly, just because optically, to Guy's point, just because optically spreads at the sort of universal index level are at tight levels, doesn't mean that it's still not attractive, because you're still getting the higher yields and you'll still be able to clip that sort of higher yield for a while.
Okay, so it's a more complicated picture. What about the issuance story? If we're going to be, you know, we're talking about tectonic plates shifting and big global shifts, and one of those is fiscal spending in Europe, funded perhaps by, as the bond market was assuming, a lot more issuance. So how does corporate issuance stand up to that kind of sovereign issuance?
Okay, so sovereign issuance, certainly this defence sort of extravaganza that we're about to embark upon. That will be funded through lots of different means on the sovereign side. From a corporate perspective, they will have to play their part, right? Because if you have all the defense manufacturers who need to ramp up capex to fund, you know, higher demand, you have all the ancillary stuff that comes with it. You know, it's, you know, steel, aluminium, all the other metals that go into that, petrochemicals. Everybody probably needs to spend some sort of capex. So we will see additional supply from corporates. Already year to date, we've had about 186 billion euros of supply in European IG. We're expecting, I think the forecast for the year is 750 billion euros. And so we're sort of on track, but I could see that ramping up in Q2, Q3 as we start to see capex plans and everyone has a better sense of the capex plans that they need to put in place for this.
Does the market absorb all of that then? You've got the issuance from the corporate side, you've got the sovereign debt issuance as well. Do we get to a point, was this week a reminder that the bond market only has a certain level of threshold when it comes to how much additional debt it can absorb?
No, there's nuances, right? You pick your point of what you want to buy, and if all-in yields are still attractive, well, why not? If you could buy a triple B in Europe at sort of 20, 30 basis points wider than you could buy it before, and you still like that credit, and you can see that the credit fundamentals outlook for that particular industry is favourable, then why not?
Guy Johnson has clarity now on what the tariff strategy is, thanks to Scott Bessent. Do you?
Perhaps you could share
I listened to Scott Bessent yesterday. I got some clarity. He at least delivered some. But how much volatility are we going to see? Can this volatility continue, I guess, is the question that Tom's asking.
Yeah, I think that volatility can continue. I think there was a quote that I saw earlier which said European or investment-grade credits really like the general direction of stronger growth in Europe and, you know, that extra demand that's going to come. It's the journey to get there, to get to those high yields. It might be a little bit bumpy, but I think generally we like the direction that we're going in Europe. And it's a vast difference from where we were at the start of January, where we thought minimal growth in Europe and we were picking through peripherals and thinking, you know, Portugal, Italy, who is it?
Many paths ahead and they all appear bumpy, Tom.
Bumpy, but we're back to some modest European excitement, which is what we saw yesterday from one of the CFOs.
But Europe's got an awful lot of work to do if it wants to get there. If it's going to fund defence, what else has to give? Is society really ready for that extra spending on defence? I think is the key.
From welfare to warfare, as one of our guests said yesterday.
Well, the interesting thing will be about how we put ESG concerns on hold as well.
Okay. Omotunde Lowell, thank you very much indeed. Plenty more coming up. Stay with us.
Not enough time.
This is Bloomberg.
Welcome back. It's Friday. This is the opening trade, Friday the 7th of March. Let's have a look at the futures picture for equities and tell you 29 minutes ahead of the market open where we are expecting to be. And we're expecting to be in negative territory. DAX futures in particular on the back foot this morning, down by just over 1%. Yesterday, the session in the United States whipsawed to some degree, but essentially selling off quite heavily, down by more than 1.5%, down by 1.8%, in fact, on the S&P by the close. And not really getting a huge amount of relief, Guy, from a bit of a backtrack on some tariff policy.
No, a lot of the selling came later in the session, so Europe needs to react to that this morning. In terms of the bond market story, what is interesting is that the German bond market is catching a bid this morning. Yields are lower, but elsewhere on the continent, BTP's yields are rising. We're seeing a sell-off in Italian debt and in French debt this morning, as you can see on your screen. So it's as we come towards the end of the week, is that a kind of end-of-the-week trade in terms of what we are watching? You've seen huge volatility in this space this week, and in some ways spreads have actually tightened up a little bit, now beginning maybe to widen out once again. Everybody's understanding of what is happening here remains very, very sort of skin deep at the moment, and I think we've got a long way to go in terms of our understanding of what it's going to mean ultimately for bond markets.
But what we can do is join the dots, obviously, between the defence spend and what's been happening in the bond markets, which brings us to our next conversation. Yep. The European Union agreeing to begin discussions, of course, on a long-term reform of its fiscal rules to allow member states to spend more on defence, following a push, of course, from Germany. French President Emmanuel Macron said the European Union needs to increase its defence capabilities.
C'est-à-dire que compte tenu de la menace et quoi qu'il advienne.
Given the threat and whatever happens in Ukraine, we need to increase our defense capabilities, and we need to build, in the next few years, autonomous defense capabilities for Europeans.
Let's cross over to Oliver Crook now, who is in Brussels with a guest who can expand on this. Oliver.
Yeah, Tom, we've been talking about European defense for the better part of the last, really few years, and really that conversation has accelerated in the last few months and weeks, and frankly in the days. So we're very pleased to be joined by Europe's Defense Commissioner, Andrius Kubilius. Thank you so much for speaking to us after this summit that we've just been assembled, the Emergency Leader Summit, to talk about how to deal with defense across Europe. I'd like to begin, if we might, just on the last few days, the last week. We've seemed to have had a sort of the embodiment of the Trump doctrine as we've been hearing it. It's really coming into reality. We've had the Kremlin over the last few days sort of endorse the Trump administration's worldview. How does this change the situation for Europe?
Well, first of all, good morning, and thanks a lot for inviting me. Well, definitely, during last weeks we see, what I would call, quite a turbulent development. Mm-hmm. It's still perhaps not very clear what finally will be American strategy. We can, watch how it's evolving. Of course, from another side, there is more and more understanding among European leaders that we need to take much more of responsibility on European defense onto our shoulders. Also, much more of understanding, that threats coming from aggressive Russia are real threats, and what intelligence services of different countries are saying that Russia can be ready to, for new aggressive actions against EU or NATO member states before 2030. That is influencing all of our decisions.
And one of your jobs is to basically figure out what is there, what is still needed, and part of your job is to put a price tag on what that is right now. So what is the price tag in terms of European defense as we see the United States withdrawing in order to expand a Sky Shield, to have all the military hardware, potentially extending the nuclear umbrella from France? What is the price? Well,
the price depends, first of all, on NATO evaluations. We are speaking very clear language. We are not, trying to replace NATO. NATO now is reviewing defense plans and also so-called NATO capability targets. As we understand, they will come out with the final numbers for June summit. So we can evaluate, some of those numbers which are appearing in the public media even. As usually, when there is a secret, so media is able to find some of those secrets. So based on those numbers, which we even can read, for example, last year was very important publication in Die Welt, approximate value of just implementation of NATO capability targets, which means tanks, artillery pieces, vehicles, and so on. It's around 500 billion. But if we're adding air defense shield, military mobility needs, space defense shield, so the numbers are increasing very rapidly.
And when you say increasing very rapidly, do you mean they double, triple potentially? Is this what kind of order of magnitude?
Potentially that can be. So that means that really the financial needs are very, very important. So that is why the decision, the announcement, and which by Commission President of this initiative, Rearm EU, and what was done yesterday by the Council, are very important.
But they may not go far enough, right? This is one of the concerns. So my question is, after we've got this 150 billion loan, we've made some fiscal space for a number of member states to take out more debt, though many will say that A, they're not following the rules to begin with, and B, the limiting factor is not the EU rules, it's the bond market and it's the debt that they have already. Does Europe need to go further? Do we need to start having a very active discussion on joint debt? Do we need to talk about frozen Russian assets? Where do you see that coming from? Where is this money going to come from?
Yeah, I would say we need to be open for, to see how things will develop. So now really the space is created for member states to invest much more into their defense. We see some very strong actions from, for example, from German side, from forthcoming new German government. So we need to watch, how much member states will use those opportunities, and of course we need to be open for possibilities to look into some kind of new instruments. But that will come. It's not we cannot predict now. But as I said, we need to do first steps and then to see what is coming.
And I think one of the concerns, though, is also at the EU level is so built on consensus building, which is part of the nature of democracy. But in sort of war times and trying to scale things up, it is not always the most effective mechanism to get things done. We're seeing some of that at the fact that there were only 26 members that signed one of the major conclusions from the summit. How difficult will Viktor Orban make these decisions for the European Union? And are you confident that you'll be able to roll over sanctions next week?
Well, of course, it would be good to have, unity very strong without any problems. But life is life. And I hope that, really we are able to make the needed decisions. 27, sometimes it appears that, 26 are able to make an agreement. We see a lot of, informal consultations among leaders in Europe, in London, in Paris, and so on. So things are moving. I'm always quoting Jean Monnet, to myself and in general to public, when he said, in 1957, when the Rome Treaty was signed, that European community will be created during the crisis, and what will be created during the crisis, that will be community. So now we're facing defense crisis, and that is why it's very clear that this crisis is pushing everybody to make decisions. Mm-hmm. I hope that the governance crisis will not come, that we should need to look into some additional possibilities.
And we've heard some proposals from various member state leaders. We heard from Giorgia Meloni floating the idea of extending Article 5 protections to Ukraine without full NATO membership. Is this something that is gaining traction in conversations?
Well, of course, that is not my portfolio. Yeah. I'm much more on material things, on industry. But definitely guarantees. We need really a just peace and peace through strengths, and strengths also should come for security guarantees for Ukraine. How it will be established, well, we shall see. But it's very clear that there is clear understanding that some guarantees are needed very much.
And moving into the material world, Starlink, for example, an active part in the Ukraine war. How quickly could Europe replace Starlink if it were required?
Of course, we are looking, well, we hope that, Americans will not do some kind of such things, because it can hit very much, credibility of Americans as partners. But in any case, technologically, there is possibility to replace. Either in few months' time, or even if the need will be very quick, it's possible.
And we've also heard from Trump yesterday saying that basically he will not defend NATO nations that are delinquent. There's a lot of conditions now being set by the United States on basically whether or not they will honor NATO obligations. Do you believe that Article 5 still covers, do you believe that the nuclear umbrella still covers all of NATO? And I'm thinking primarily of Lithuania, whom you were prime minister twice. Do you still have confidence that it's under the U.S. nuclear umbrella?
Well, I said, that credibility is a very important factor in such organizations like NATO, in common defense and so on, and we need to, and everybody should keep, its own credibility. So, well, we know, style of President Trump, to demand big investments and so on. Also in Europe, a lot of countries are doing that, but not because of Trump, but because of Putin. So that is what we need to recognize. And definitely, bigger defense spending is very important. But also, it will be very important for us to understand what is longer-term strategy of the United States, especially in their relations with Russia. Because now we hear also that, American side wants to reestablish good relations with Russia, which for me looks, how to say, I don't see the benefit in that, because good relations with aggressor really usually encourages aggressor to become even more aggressive. And also it can encourage, other authoritarian aggressors to start to believe that they can do what they want, and they will not be stopped by the Western democracies.
Andreas Kubilius, thank you so much for your time. The European Defense Commissioner, they're sort of reviewing a number of the issues and the new paradigm, the new reality for European defense currently being thrashed out, and basically also assigning the price tag to that, which is still, it seems, a number in flux.
Oliver, thank you very much indeed. Interesting conversation with Commissioner Kubilius. He's saying that EU defence investment needs to increase rapidly. The problem is, though, that appears to be easier said than done. Fascinating conversation, also indicating that Starlink can be replaced rapidly in Europe. That's significant. What are we going to do next? We're going to talk about what is happening in the European equity market story. We're running up to the market open this Friday. Broadcom shares surging late trading in the United States. Is there a ripple across here in Europe? We're going to figure that one out next. That is coming up. This is Bloomberg.
China's exports reaching a record $540 billion in the first 2 months of the year, as higher US tariffs and the threat of more to come drove front-loading of shipments. It comes as China's top diplomat accused President Trump of taking a hypocritical approach to bilateral ties and denounced the US levies. For more, we are joined by Stephen Engel, Bloomberg's chief North Asia correspondent, who's been following all of this for us in Beijing. Steve, is this as good as it gets then for the export engine of China?
Well, it very well could be for this year and during this uncertain times, because we don't know if those tariffs are going to go higher as been promised by Donald Trump. Because keep in mind, the 20% tariffs that are in place now are just on the fentanyl issue. The longer term structural issues of the trade imbalance have not necessarily been addressed through tariffs yet. Yes, that can be negotiated, but we simply don't know. And that uncertainty is why there was tons of front loading of orders. And that's why in those first 2 months, we had that surge, $540 billion in exports, for China, leading to, by the way, because imports dropped more than 8%, because the Chinese economy, let's face it, is not humming yet anywhere close to it. It's still struggling to get that confidence. And that's why the policies this week at the National People's Congress has been really targeted at giving an injection of confidence to the consumer in China. So imports were down 8.4%, leading to another record trade surplus for China of nearly $171 billion. That will obviously exacerbate the trade friction between the United States and China. But this could be the best for the rest of the year as those first batch of tariffs, 10, then now up to 20, start biting.
Stephen, the foreign minister's speech comments at the NPC were fascinating. Really strong language being used. What should we in the West take away from those comments?
Well, there's a number of different nuances you can kind of read into it. Obviously, Wang Yi, the foreign minister, is probably the most outspoken of all the ministers of the major ministries here in China. He is known for speaking his mind and using a sharp tongue. And he did not disappoint today. He talked about the Trump administration being two-faced, quote unquote, on the fentanyl issue. And Wang Yi essentially said, this is not a China problem. We are one of the toughest on cracking down on narcotics in the world. which I can probably attest to. That's true. But the Trump administration says they haven't done enough to curb the precursors of fentanyl. But Wang Yi, again, and this has been a constant narrative through state media, is that the fentanyl problem is a U.S. demand issue and is one that should be resolved in the U.S. So that's a standing point, a sticking point between the two, and is probably why Donald Trump essentially added another 10% tariffs, because they see a lack of action. And that's why Wang Yi talked about a two-faced response from Donald Trump. There were other statements as well. They basically said China opposes double standards, trickery, and bullying. Obviously, not so veiled threat against the Trump administration. Wang Yi, kind of the face for the more acerbic side of Chinese diplomacy.
Yes, acerbic diplomacy. Stephen, thank you very much. Stephen Engel, Bloomberg's chief North Asia correspondent. Thank you very much for that. Let's pivot from that narrative to what's happening in markets. Our Markets Live executive editor, Mark Cudmore, joins us now from Singapore. Mark, we seem to have seen either the start or a real pickup in some big new trends just this week. We talked yesterday about the strength in the euro. That's one of them, but there are plenty of other big shifts happening in markets. How sustainable do these new moves look to you?
I think that we are in the midst, over these months we've kind of gone through, of a paradigm shift in markets, of trends that will last for years. I think one is the era of US exceptionalism in markets is over. I think that was heralded at the end of January with the combination of Trump's tariff policies and DeepSeek. I think as a facet of that, and it is very linked, I think we're at the start of a sustained dollar downtrend. And I think finally, it is actually slightly different from the dollar downtrend. I think we're at a new era of euro sustainable appreciation. You know, even when I've been bearish dollar since December, and even when I was bearish dollar, I didn't like euro as the way to kind of play it. But that has changed immensely in the last few weeks with their new kind of fiscal spending, their new kind of plans to change the whole way that Europe has approached spending and defence. So I think that's changed the whole narrative there. So all these trends are sustainable. However, for the next couple of weeks, I am very nervous. They've gone a long way very quickly, and just because they're multi-year trends, it doesn't mean they go in a straight line. So I expect a lot of volatility in the coming weeks, but ultimately I think these are trends where the pullbacks will be bought into.
Mark, if the euro goes up, is the implication that money is flowing into the eurozone? And if money's flowing into the eurozone, is it flowing into European equities? I.e., is this a zero-sum game? If Wall Street, if America goes down, does Europe come up?
It's not. I don't like necessarily using it as a zero-sum game, because that's clearly not been the case, in history over long periods of time. But I think on a short-term basis, yes. I mean, part of this, the reason that euro trade is good is that Europe is talking about expanding its debt pile, so having more fixed income assets to buy. And therefore, ultimately, a lot of that money going to the euro is going to go into fixed income assets. But you're right, that takes time, that takes years, that takes months. So I think in the short term, it is positive for European equities. But again, this is where I'm a little bit worried that European equities have had such a tremendous run. If people want to get up on the euro trade, they're a little bit worried about buying it at these levels. I think instead, they're going to be excited by any dips to buy.
So, Mark, you have skewered the US exceptionalism narrative. Do you not buy into Trump's pledge of a golden era for the US, tax cuts for the US, Mark?
I think he really does want to deliver tax cuts, and I think there are many large structural changes that this administration is doing to the U.S. economy, and there'll be some winners and losers. But I think that the backdrop here is that we had an extraordinarily overvalued narrative of U.S. stocks were the only option out there. TINA, there was no alternative for investment, and therefore valuations just got way too stretched. With Trump ripping up the old world order that had been so beneficial to US, it means that premium has to come out. There is a new equalization in the world, and that's bad for overpriced stuff like US stocks and good for discounted stocks elsewhere.
OK, a new equalisation in the world. Markets having to adjust to that reality. Bloomberg Markets Live Executive Editor Mark Cudmore, thank you. Remember, you can get up to date, of course, analysis and insight from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's get some details in terms of the stocks to watch this Friday morning and bring in our equities team. Joe Easton leading the focus. Joe.
Morning, Tom. So we're watching chip stocks today after the US giant Broadcom soared in post-market trading. It was up around 13%, most of that tied to the AI spending and the positivity on the orders for the company. However, the thing to note is that we did see significant selling earlier on Thursday in the US peers. So the Philadelphia Semiconductor Index was down 4.5%, another rough day for that sector. So we are actually expecting to see a bit of weakness in these chip stocks this morning, given where the futures pricing at the moment are. However, Broadcom might potentially take the edge off that, but keep an eye on the key stocks in Europe as usual: ASML, BE Semi, ST Micro, Infineon in focus. Then in terms of Universal Music, all the Swifties boosting this one with their subscriber numbers going up significantly in the last period. This stock recovering from a bit of a plunge as they saw a drop down in subscriptions last year, so potentially this one is going to be higher in Amsterdam trading today. Then also we're going to be watching Salvatore Ferragamo, which looks weak again. The slowdown in their spending continues in terms of the demand for that one. It's been a rough couple of years for that stock though, so potentially a lot of that priced in. And then finally, on your analyst ratings, we've got a couple of upgrades. Akzo Nobel, Goldman Sachs likes that one. Deutsche Post up at Deutsche Bank. And also a little bit of a downgrade for Whitbread. That one could be weaker in the hotel space today.
Joe, thank you very much. Our equities reporter, Joe Easton, with the latest on some of the stocks in focus. So we'll keep an eye on chips, on Universal Music Group, on Ferragamo, as he says. The overall picture, though, will be weaker for European stocks. Futures down by 0.7% as we look to catch down with nervousness on Wall Street yesterday. This is Bloomberg.
Friday morning, good morning. We've still got a long way to go. This week is by no means done. You've still got payrolls to get through. We've got a lot to digest, a lot to think about as we work our way into this weekend. I suspect the grey matter is going to be on overdrive this weekend as we try and formulate an idea of what is happening to us right now in these markets. Yesterday's trading kind of just encapsulates that. Europe sells off hard in the morning, bumps along the bottom, rallies alongside Wall Street into the close, but then Wall Street doesn't like the view it has and sells off aggressively into the close. That's the picture we're looking like at this Friday morning. And Tom, it's reflected in futures.
Yeah, the tariff turbulence is certainly there when it comes to the futures. European futures pointing lower by 0.7%, as you say, after essentially a flat close on European stocks yesterday. The pain trade coming through for the DAX as well after some of the gains that we've seen this week. FTSE 100, as we refire that board, also pointing low on the futures. Anna.
Yes, there it is. Just appeared behind you. It is red. Yes, red on the screen.
As if by magic.
The DAX futures down by 1%. So we are expecting the general direction of travel to be downwards. Within that, could we see some exceptions or could we see some sectors that don't fall quite so much? I mean, we'll keep an eye on the chip space. As Joe was saying, we had the Broadcom numbers. That stock up 13% by the close. AI boost there. But will that really be enough to offset the general downdraft in markets? We've got also defence stocks in focus. BAE, Thales, Leonardo, Dassault Aviation. We've come a long way on this sector already this week. Is there still really further to go? Some of the opening calls or some of the suggestions are that those will go higher this morning. And Universal Music Group getting more from subscriptions. So this is the money it gets from the likes of Spotify, Apple and Amazon Music. And that's doing well for that business. Guy.
OK, here we go. Friday's session is about to start. It is time for the opening trade. We're expecting a negative start to the day. How we go from there remains to be seen. OK, so here we go. Let's show you some numbers, give you an idea of what is going on. Remember, Wall Street sold off into its close yesterday. We have to factor that into our thinking first thing this morning. The FTSE 100 is down by 0.2%. The IBEX is down by 0.7%. The Madrid market under a little bit of pressure. The 600 is out. We're down by 0.3%. We await the CAC, the DAX, the SMI. We continue to see, obviously, Germany, as I said yesterday, being the epicenter of the action right now. But we've already indicated defence stocks are going to be in focus. What happens to ASML, ASMI today is going to be really interesting. Some of the chip stocks in France, that market is down by 0.4%. So we are looking at a negative start to the day. Europe, like the United States, but maybe a little less so, has been whipsawed this week. We've seen action in the equity, bond market, fixed income market, foreign exchange market. I'll get that list right. But equities have really had a lot of volatility to deal with. So we come towards the end of this week. What do we really know about where we go next? Tom.
We await the DAX, of course, across your sectors. Food and beverage so far at the top of the list in terms of some of the gains. Most sectors, of course, in negative territory, but food and beverage up 0.6%. Utilities also gaining, maybe a bit of a safe haven tilt there, up 0.6%. You've seen oil prices up in the session, though, just flirting with that $70 a barrel level so far on Brent and WTI. Energy up 0.4%. Telecoms also gaining 0.1%. On the downside, it's the consumer space taking a knock of 1.2%. Autos again under pressure, falling 1%, and banks challenged as well. Travel and leisure also facing some pressure, down 0.8%. And just seeing if we have the DAX, no, not yet. But the biggest selling pressure coming through for the FTSE MIB and the IBEX, in fact, currently down 0.9%. The FTSE 100 dropping 26 points.
Yeah, and it's interesting. The luxury sector in Paris is what seems to be weighing there, or at least that's one of the down forces. And Salvatore Ferragamo, as we were hearing from Joe, they had numbers out. That is one of the big stocks that is dropping within that sector. That's not in Paris, of course. That's over in Italy, but the read across is there. That stock down by 7.25% right now. The loss at Ferragamo seen as bigger than expected. So that is another sector that gets whipsawed right now.
Absolutely. So LVMH down by around 1% right now. Richemont's down by 3.2%, which is interesting in itself. But Novo is the biggest points drag at the moment, followed by Richemont, followed by Siemens, followed by Astra. Banks are a little lower this morning. You are seeing a safe haven bid back into this market. Nestle is bid this morning. Some of the oil stocks are also catching a bid as well. You see Shell, Total, some of the big points gainers here in Europe this morning. Iberdrola's in the mix as well. Melrose bounces back by 4.2%.
OK, after that big drop yesterday. Universal Music Group, we mentioned this, Joe mentioned it, and then we talked about it ahead of the open. That stock is up by 5.6%. And this is the world's largest music company, and they're getting more money from streaming. And this is now pulling up the media sector. So the media sector is the best performing sector in Europe today. In a down market, that sector is up by 0.7%. So we have some money to spend on streaming music, it would appear.
The sell-off on the bond markets is easing to some extent today. Of course, you had the ECB cut, as expected. April seems to be more challenging in terms of the decision there. Over in Germany, the DAX now coming through with a print, and it is showing the biggest losses across your main indexes so far, down 0.9%, Guy.
So on the week, the Stock 600 is down by 0.7%. So we're not done yet. We've still got payrolls to get through. We don't know what that is going to ultimately deliver. But Monday, Tuesday, Wednesday, Thursday, now into Friday, we are negative. So we talk about this kind of European trade, this European bounce back, this move from US assets into European assets. It's very specific. The defence sector has been seeing huge gains over the last few days. But broadly, European indices, like US indices, are negative. But it's interesting to look at kind of what is happening here. What is the beta looking like to you? Is Europe a safer place to be? Are we seeing, like we're seeing in the United States, where we're getting a rotation out of technology into staples and areas like that? Is that what we're seeing here in Europe? And is Europe the beneficiary also of that kind of big tech rotation into other parts of the market?
Yeah, it's interesting that I've just pulled up year-to-date what we're doing on the Stock 600, and construction and materials is doing OK, industrial goods and services, that plays to the infrastructure story and the defence story. But actually better than those year-to-date is banks. And this is all to do with our reassessments of how many rate cuts we're going to get here in Europe as a result of the fiscal spending, most latterly. Let's get into a conversation about where we are on these markets. Joining us now, Amélie Derenbourg, who's head of multi-asset strategies at Amundi Asset Management. Amélie, thank you so much for joining us. I want to start with a big picture question, because it seems as if these markets have been captured by a lot of fast-moving geopolitical developments this week. And I wonder how you're making space for all of this news flow. Are you thinking about big tectonic plates shifting, and are you investing around big changes in themes, or are you keeping quite nimble and tactical? What's the view right now? How do you approach these markets?
First of all, good morning. Thanks for having me. And regarding your question, do we believe that we have major shifts in geopolitics and in European economy? Yes, absolutely. The news coming from Berlin yesterday is quite substantial, and we believe it is somehow a sort of a paradigm shift for Europe, which was made necessary also by the changes coming from the US administration. So yes, it is very substantial, and it is to be applauded. We believe that it's good news that Germany is making some changes in the daybreak, is launching a big infrastructure plan that's necessary and probably going to improve potential growth in Germany and have repercussions elsewhere. So we believe that's a very important element, and that it needs to be factored in. It's not easy, though, because the size of the package is quite substantial, but the end effects on inflation, on growth, are difficult to assess. It's not very straightforward. You have a lot of different factors playing in, especially coming into the timing. When is it going to start having an impact on inflation and growth, etc. That's not easy. That's not easy to say. And we have also, all the elements coming from the US, especially on the tariffs side. What strikes me in terms of tariffs is the fact that initially, markets were very, let's say, complacent with the tariffs situation, assessing it as, at the end of the day, with all policies mixed together, growth positive for the US. And now markets have second thoughts regarding on that. To me, tariffs are more similar to a VAT hike. If you have to make a comparison, it's positive for fiscal on the fiscal side, but it's negative on growth, and it's hiking the price level in a country. So it's unlikely to be a growth positive, very unlikely.
Okay.
And we see that markets are now, rethinking that part. That's also interesting.
Yes, that's a really interesting comparison with the VAT, given that the White House is not huge supporters of VAT, we understand. But away from that, so you talked about what's coming out of Berlin. Big commitments, big change of direction coming out of Berlin. In the moment, the instinct has been sell bunds, buy German construction and defence stocks, and buy defence stocks more broadly. What's next, though, in that trade?
I think we will have to see the development on the fixed income markets. That's going to be an important factor as well, to see how equities will develop. We are currently overweight European equities, so we believe at Amundi in the multi-asset business line that European equities have further to go. We might see some ups and downs and volatility because the rally has been quite substantial so far, so having a bit of profit taking or respiration is not to be excluded. But at the end of the day, we believe that the situation is improving in Europe from very low levels, but the economic momentum is in the right direction. It's going to be amplified by the plan that we're having from Germany. So this is also a good point from that angle. And we think that European equities are cheaper, very under-owned compared to US equities. So that's also something that could lead to some further rebalancing of portfolios towards European assets. And also, if we see the euro appreciation, even if it's usually not positive for European profits, we believe that it's positively correlated with European equities because it shows the interest and the inflows into Europe. So, despite the volatility that we might see, and today we have Payrolls, we think it's going to be positive for European equities.
Okay, Amélie. Okay, so stronger euro, not necessarily a headwind for European equities, and you would lean into that trade at this point. What level of yield would cause a concern? At what point would the sell-off in the bond markets in Europe prove a headwind for the story around European stocks?
I think we have a bit of space there. We do not expect the sell-off to continue we do not expect much higher yields going forward. It's likely that the 3% level might be tested on the bund because the positioning is quite elevated on a European fixed income market. It was somehow a no-brainer deal at the beginning of the year, and now market participants are a bit caught by surprise by the size of the package. So it's likely that we will have some positioning cleaning further. Going further in the fixed income market. But as we speak, the sort of terminal neutral rate on Europe is close to 2.75%. That's quite elevated. It hasn't been the case for decades, for years and years in Europe. So I don't believe that we have more a lot of space to go higher. It's a game changer what Germany has done, but it's not going to double, the rate of European growth and inflation in the coming months. So we have to stay calm and see how markets move, but probably there will be some interest when rates move likely a bit higher, though. So I don't. Maybe we will test, some pain level, but I don't think it's going to be durable.
Is there a significant tailwind that we should be thinking about when it comes to China's attempts to hit 5% growth? When it comes to European equities, is that something that investors should be factoring in?
Yes, I think so. We are getting more positive on Chinese equities as well, because we believe that the plan that is in place is relatively credible. There was no big positive surprise. It was roughly in line with what consensus had in mind. But we think that the momentum is going to be relatively positive. There are some tentative signs that the housing market starts to stabilize in China. Part of the package is focused on Chinese households, and we think that's positive as well. That's a key area of focus for Chinese authorities. So we think that going forward, it's going to have an impact in Chinese growth and, as a consequence, also on European equities that are linked to Chinese equities. So we're getting, slowly but surely more confident on that part as well, yes.
OK. Amélie, thank you very much. Indeed, European stocks under pressure today, but the view from Amélie de Rambure is that European equities have further to run. Head of multi-asset strategies at Amundi Asset Management, thank you.
They're not running this morning.
No.
Still a bit of a sell-off in place. Let's take a look at the Core 6, figure out what is happening there. This is what the story looks like with some of Europe's biggest stocks. Luxury is under pressure. LVMH is down by 2.3%. We are seeing a tech rebound. ASML is having a much better day on the back of what we saw yesterday from Broadcom. Some of the pharma stocks are under pressure, but this is a market that seems to be seeking safety. Nestle is up by 0.5%. What else are we watching? Joe's here with the details.
So we are seeing a bit of a boost for Universal Music today, Guy. This after the strong subscription numbers out of the company based in Amsterdam, listed in Amsterdam. All seems to be tied to their contracts with Spotify, with Apple Music, Amazon Music, that feeding through into the business. And really interesting because there is a bit of a debate going on about whether the stock should actually be relisted to New York, given the pressure from the activist Bill Ackman, who has a stake in that. But seems to be it's doing quite well on the Amsterdam Exchange at the moment. We're up 5% on that one. Then we'll check in on those semi stocks. A little bit weaker on a couple of those names. As Guy mentioned, ASML was slightly higher, but we are seeing a bit of a drop down in Infineon, ST Micro as well. BE Semi very slightly lower. Despite the Broadcom positivity, we did see pretty broad selling in the US in the late trading in terms of after the European close, so that feeding through. Salvatore Ferragamo, that looks pretty brutal for that one, down another 12%. And this has been one of the worst performing stocks in luxury over the past couple of years. It hasn't really had the boost that we've seen in some of the other peers following trading updates recently. Down again, orders weakening, Morgan Stanley slashing their estimates for earnings in a note this morning. Then we've got Elia Group. This is in power over in Belgium, doing a massive share placing, according to breaking news that came around an hour ago. It's a couple of $1 billion, I believe. And that stock, though, getting a boost, potentially meaning the funding outlet looking stronger. They also had a trading update as well, but looking like a decent gainer for that one in Belgium today. And then finally going to look at Eutelsat once again. It's the stock of the week. It's trebled in value this year to date. Anyone who owned that before Christmas is absolutely laughing this week. Coming down 7%, but only a tiny drop given the rally we've seen. This is after Goldman Sachs has actually upgraded it to neutral. Not a single analyst had a buy rating on this stock during this rally. It's pretty incredible. It's coming down very slightly, but as I say, up around 200% for the year. Pretty good return for those Eutelsat investors.
Thank you very much. Joe Easton from our equities team with those movers. Coming up on the programme, Wall Street ended in the red as investors turn risk-averse over Trump's tariff flip-flops. We've seen a few of those. We will discuss the tariff uncertainty, how it's impacting global trade. That's next. This is Bloomberg.
As it relates to the US, it's just so regrettable. It's not really adding efficiency to our operations and not adding efficiency to our customer operations. So we gain new business. We do more customs filings, for instance, so it's not necessarily bad for us. But I think overall, these disruptions are not good for the economic development and the building of wealth.
Tobias Mayer, the DHL CEO, who's got a ringside seat in terms of the tariff story, talking about the impact it's having on his business and the uncertainty that it is certainly creating. President Trump pausing tariffs on Mexican, Canadian goods covered by the North American trade agreement. It's a carve-out for cars. We're all over the place. We don't know yet what is going to be happening next. We're building up to a big moment, we think, on April the 2nd. But there's a long way to go between now and then. Here to provide clarity and illumination into what is happening here, Brendan Murray, who leads Bloomberg's global trade coverage. Good morning. I'm joking, of course. Illumination and clarity is very hard to come by right now. Where are we on Friday morning?
Well, I think what we've learned this week, the main lesson is that tariffs, when applied broadly, are a blunt instrument, and they can do a lot of damage. You can create, unintended consequences for industries that you're trying to help. The car industry came to the president this week and said, "Please don't do this to us. This is going to crush us," and he relented.
But he did it initially. They've been saying that for ages.
Yeah, exactly. And they only have until April 2nd. So, we'll be back at this point, in 3 weeks. So I think the main lesson is that this rollout has been messy of these tariffs. This is only the beginning. It's only going to get more complicated. April 2nd comes the reciprocal tariffs. We don't know how those are going to apply to various countries. So in the meantime, and don't forget, next week is steel and aluminum tariffs time. So this time next week, we could be, and that's Europe, that's Asia, that's South America, that's, that we could be in a global trade war by this time next week.
Okay, we look ahead then. Steel and Aluminum Day. It sounds like it deserves some fanfare. Let's talk about the reciprocal tariffs, Brendan. Do we have any better sense of what that actually means? Because if I take it at its most sort of literal meaning, it means they put the same tariffs on India and South America as India and South America have on US goods, because that's where the big tariffs are. But I feel as if that's not the intended meaning.
We don't have a whole lot of clarity on this. Basically, our understanding is that they will go country by country and say, look, not just at your tariff rate with the U.S., but they'll say, what about all these other things? How do you treat our banks? How do you treat American companies with value-added taxes and that kind of thing, these non-tariff barriers?
So it's reciprocal in a very general sense.
Exactly. Yeah, and could be very, very broad depending on how they define non-tariff barriers.
What do we know about how other nations retaliate? What details do we have about Europe? Europe is clearly in the spotlight now. Amid all the uncertainty, he's had a target on the back of Europe for a long time.
Yeah, they're next, as far as we can tell, and they're more prepared than they were last time. They have different tools. They have a list of American products that they're going to target. So the retaliation from Europe, it will come quickly. And it will be it will set off a negotiation, and that's the whole idea. That's Trump's MO is I'm going to hit you hard with tariffs, and then we'll sit down at the table. So we'll see how the Europeans react, particularly to these steel and aluminum tariffs next week.
Punch you in the face, and then let's sit down and talk. Brendan, thank you very much indeed for helping us get some form of clarity in terms of the uncertainty around the tariff regime. Brendan Murray, of course, Bloomberg's global trade editor, who has been kept alongside the team very, very busy and will continue to be, it seems, in the weeks ahead. Let's discuss the impact across the markets, then, of these tariffs on European stocks with Bloomberg's Farah Abrahari, EMEA. In fact, equity markets editor, EMEA equity markets editor. I should know how to say that by now. Talk to us about how the markets have adjusted to this thesis. Is it, for the markets, would it be clearer and cleaner just to know that tariffs are there and that is the end game versus the U-turns and the whipsaw? I mean, what is the least bad option for the markets at this point?
Well, least bad option is honestly unclear at the moment because there's so much confusion, Tom. The market, you see, it starts pretty low and then it bounces back up and then we go back down because the headlines are coming in so quickly on the tariff side. But in terms of Europe, because we're discussing the impact in the region, it's really more concentrated in the sectors that are most exposed. So, for example, autos is one that we've seen a lot of movement in this week. falling pretty sharply on Tuesday, but they've recovered over the past couple of days, especially when Trump said that there will be some delays, as we were just discussing with Brendan. But there is just a lot of confusion there in the market. Miners is another one to watch out for. Generally, though, Europe is not badly hurt as much as we're seeing different markets because it's seeing support from other things such as Germany's spending and potentially China's.
So that takes
growth.
us to defence stocks. Germany spending, defence stocks, massive rally. So what are you hearing? You talk to a lot of people who are running money. They're trying to figure out what to do next. Are they convinced that this defence stocks story has got legs? Is there further to go? Every day it feels like we're getting big movements in this sector. Generally up, a few days down, but generally up.
Generally up really quite strongly, over 90% over the past 12 months. So investors are willing to take the gamble with defense stocks, Guy. I mean, they are really expensive compared to the general market, but they're saying that eventually analysts will start upgrading those estimates further, and then they won't look just as expensive because, again, Germany is coming in with such potential. There's so much potential for spending on that front. Everything that's happening with Ukraine as well, there's more potential for defense to rally even further. Rheinmetall is one of the darling names in the sector, up 12-fold since the invasion of Ukraine back in 2022. So overall, analysts are upgrading. Investors are expecting more upgrades, and they're expecting that to translate into, better profits for the sector. And they're buying. They just continue to buy.
Yeah, and we were wondering around one defence name or company that operates in defence yesterday, whether the reason it sold off in after its earnings, it didn't upgrade its guidance, and that maybe came as a surprise. Let me ask you then broadly about these markets. How have valuations shifted then in terms of European stocks? Because there's a lot more enthusiasm for Europe, but how long does it sort of stand up to the valuation test?
Absolutely. I'll focus a little bit on Germany specifically here because the DAX is outperforming significantly this year, up 17%. The S&P 500 is down over 2%. So Germany is now trading at the highest premium to the Stock 600 in 16 years. But the expectation is that this will eventually, everything that's happening with Germany will eventually feed again into earnings. It all goes back to that. Investors are just so bullish, especially on Germany at this moment, and that's what we're seeing come up in the market right now. And they're anticipating that the scale of the fiscal support is, again, Germany is one, but again, China, their growth target was really quite bullish for the market, and that means that potentially we're going to see more support from that side.
That has a read across into some of those mining names, doesn't it? Farah, thank you very much. Farah El-Barahi, Bloomberg Europe, Middle East, Equity Markets, Macro Trends and Strategy Editor. Coming up on the programme, after the ECB cuts rates to 2.5%, President Christine Lagarde pushes back on claims the central bank has a role in funding EU defence. That's next. This is Bloomberg.
30 minutes into the opening trade. This is what European equity markets look like. We are reacting to the sell-off we saw late in the day yesterday in the United States. Wall Street's ending softer by some considerable margin, and we have to react to that. On the week, we are down. That is worth bearing in mind. European equities are lower. But let me just give you a quick look at the euro as well, because this is significant, and I'll take you back to the equity story in just a moment. That is where we are on a two-day basis. As you can see, we have been climbing, but it is significant to fold it back into the equity story. If I currency adjust the S&P year to date, it is down by nearly 7% if you factor it in euros, 6.86%. The DAX is up by 16%. So the S&P down by 7%, down, and the DAX up by 16%. There's some significant European outperformance happening here. All of this obviously takes us to the ECB. Yesterday, cutting rates by 2.5 to 2.5%. It was a 25 basis point cut. Christine Lagarde, the president, says the bank doesn't have a role in helping governments finance more defence spending and will stick to its mission of price stability, the single needle in its compass. Lizzie Burden was there yesterday. She's still in Frankfurt. So we've had a 25 basis point cut. Where do we go from here?
Well, it gets hairier from here, Guy. The question of April is very much open because you've got the hawks saying, look, we need to slow the cadence of cuts now. We need to wait and see what happens in terms of Donald Trump's policy, whether that's on tariffs or Ukraine and how the EU is going to retaliate. But you've got the doves saying disinflation's well under track. And so why not keep cutting? And that's why they have this compromise in terms of the language on policy now. So they're saying it's becoming meaningfully less restrictive, and a lot of head scratching going on as to what meaningfully means. Normally, I'd say, look look at the forecasts for clues. But yes, they've revised up the inflation forecast because of higher energy costs. Yes, they've revised growth down, partly because of trade, but these numbers were pretty much obsolete by the time they were published because they don't take account of this whatever it takes pledge from German Chancellor-in-Waiting Friedrich Merz. There was no mention of it in the statement, but Christine Lagarde said, we think it's going to boost European growth. So really setting the stage for this showdown in April. We've heard a bit of ECB speak this morning. France's Villeroy de Gallo saying that they're going to keep their options open. That's what the pricing reflects. And you mentioned this question about whether the ECB is going to print money to finance defence spending. Absolutely not even discussed, according to one policymaker. It's the ECB's mandate, as you say, to focus only on price stability.
Lizzie, thank you. Bloomberg's Lizzie Burden in Frankfurt with a wrap-up of all we've heard from the ECB. Let's think about how markets digested that and all of the news flow surrounding defence, infrastructure investment out of Germany and the European summit. Let's put it all together from a fixed income and FX perspective. Lauren Van Biljon joins us, portfolio manager at Allspring Global Investments. Lauren, nice to have you with us. So I'm interested in this idea about whether we've gone too far too quickly on a number of assets. And I'll start with the euro and then come to rates. On the euro then, 108.50. Are you thinking, you look at that and you say we've come too far too fast, or you say this is the start of something much bigger for the euro, stay in there?
Yeah, I mean, that is the real question, isn't it? Because the euro came into this year universally unloved. I'm not sure I saw a single 2025 outlook that didn't have an underweight euro, at its pick. I mean, at Allspring, we had a short to the euro for Q4 of last year, very profitable. But we actually closed it at the start of this year thinking that sentiment had just gone too negative on the euro. And we've seen that swing in spectacular fashion, particularly this month. As you say, up now at 108 and thinking about 110, which is interesting. But it has happened really fast, and it's happened on some really strong fiscal potential out of Germany at the Eurozone. But nothing is confirmed yet.
Yes.
And we've still got the fact that, yes, defence spending will be a driver of growth, but the multiplier you get is nowhere near what you'd get on, say, social services or sort of broader investment.
OK, and that's important when it comes to how much this trickles down then into the growth story for these countries.
Absolutely.
And I want to ask you about, it's interesting, you mentioned, we've come a long way very quickly and it'll take time, because I got a note from TD Rates, Pooja Kumar at TD, with a note out this morning going long 10-year bunds and saying that, a significant growth-led repricing still needs more evidence, to your point. There's a long way to go still here, and they doubt that there will actually be much impact on issuance in 2025. So have we just priced all of this in far too quickly?
We've priced it in very, very quickly. And, of course, looking ahead, next week, but also into April, we're going to have a lot of trade tariffs. And we know Europe will be a target. So right now, the market focus is very much on the upside growth risk. But I think coming into view, possibly next week, possibly in a few weeks' time, is going to be that the more downside risks and perhaps upside inflation risks. I mean, one way I do like to think about possible, at least short-term levels for currency is using technical charts, 200-day moving averages. Say on the weekly euro, we're about there. We're not too far from it.
Yeah.
So I wouldn't be surprised to see a bit of a stall, at least, until things become clearer.
Are European government bonds a safe haven asset at this point, after a week in which we've seen a 30 basis point move in a German 10-year?
Yes.
Yes.
Longer term, absolutely. I think this, in a way, this very combative US administration could make Europe stronger as an entity, right?
Yes.
It gives them something to band together and to have that sort of external threat.
That's going to cost money.
It will cost money, absolutely. And hence the 30 basis point move. And it's that re-rating of what is the structural deficit in Europe, what's the structural outlook, that sort of longer term, have we seen a shift?
Can the rest of Europe take that? Because, Germany's got a debt-to-GDP ratio that I think is sort of 60-something%.
Yep.
That's not the case when it comes to the UK, Italy, France. The list goes on and on.
Yeah.
Can the rest of Europe take a much higher debt story? Because if we're going to be funneling money into defence, as you've already indicated, the multiplier is much lower. If we have to take that money away from welfare and other areas, then we are going to see potentially an economic slowing, not an acceleration here in Europe.
Well, certainly a consumer that is perhaps less secure. But in Europe, that's been the case pretty consistently, right? It's been that US consumer aren't performing. One thing to consider is, and this is perhaps controversial to say, but what about some sort of a move towards a more common European defence project.
Yep.
Think of all the synergies there are to be made when a...
But it's still going to cost lots of money. Replacing the US security blanket is very, 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 very expensive.
It is. It is, absolutely. Choices will have to be made.
Yeah. Does that have a negative economic effect, do you think? But we need an economy that accelerates, not decelerates, if we're going to fund higher levels of debt. We're going to get the higher levels of debt. Are we going to get an economy that's going to be going faster or slower?
Slower. Yeah, it's a good question. I mean, potential GDP growth in Europe has been fairly tepid anyway.
Yep.
I've seen figures that say, well, maybe this puts another, out of Germany at least, puts another 0.5% onto German potential GDP growth. So certainly Germany has the fiscal space that other European nations don't.
Yep.
But let's not forget, this is a huge economy in the globe. It's coming off a really macroeconomic low. If you look at, say, the surprise data, though, the economic surprise data out of Europe has actually been turning positive. So again, it's that story of extreme sentiment, finding a bit more, coming back to neutral.
Lauren, is 3% on the German Bund, the 10-year, is that the ceiling in the short to medium term?
It feels like the short-term move is running out of steam, like you say, around these sort of levels. But looking forward, I'm sure all your guests have made the same point, right? How much uncertainty there is and how much policy uncertainty is still to play out, both domestically and abroad. So whether that's the right level in the longer term, I think is going to depend on the interplay of downside growth risks, upside growth risks, inflation risks, and that we just don't know right.
Guy touched on the UK. There's a line crossing on the Bloomberg terminal. The UK Chancellor, Rachel Reeves, meeting with gilt dealer firms to discuss the economy. Of course, she's building up to a crucial speech later this month, and she has wrong-footed the gilt market before, and she's only been in office 6 months or so. What are the vulnerabilities around the UK? What are your views on the gilt markets, whether they are a buy or if there's further selling pressure as the government maybe has to adjust some of its spending plans? Yeah,
the UK has always got that issue of how much discretionary room a government has versus the mandatory spending. It's a difficult balancing act. The UK doesn't have a lot of...
How sensitive are the gilt markets at this point?
I think all rates markets right now are on edge, given the moves we've seen this year. I don't think UK rates look unattractive at these levels, really.
They don't look unattractive at these levels?
I think there's you make the case. Certainly if you think about an economy where consumer sentiment is perhaps declining, again, right, downside growth risks, opening up the way for the BOE to ease at least a little bit. But again, it's how do you price for the external news?
And are there going to have to be cuts? This is the chat now, is that basically we're going to have to see some really significant departmental cuts coming through in the UK. If defence is going to take a bigger share of the pie, where do those cuts come from?
Yeah.
And is the government really going to be able to deliver on those cuts?
Yes, and if it's taking cuts out of things that do have a strong multiplier into the economy, it takes us back to your point about there could be a growth slowdown, and then the Bank of England cuts rates. I suppose that's that supports your gilts view. Then is that the argument that you're putting together?
Exactly. I don't think there's a lot of room to cut rates anywhere, quite frankly. But I think just enough. So we focus on, say, real rates or kind of inflation-adjusted nominal yields. Yeah, most markets, quite frankly, are at levels that are fair.
Okay.
Okay, Lauren, thank you very much. Lauren Van Biljon, fixed income portfolio manager at Allspring Global Investments. I feel we've been around the world there in markets and in fixed income in particular, so thank you to Lauren for that. Coming up on the programme, as Europe rushes to boost defence spending, we're going to take a look at the venture capital funds eyeing an opportunity in this sector. We speak to the NATO Innovation Fund. That's next. This is Bloomberg.
Approximate value of just implementation of NATO capability targets. It's around 500 billion. But if we're adding air defense shield, military mobility needs, space defense shield, so the numbers are increasing very rapidly.
Do you mean they double, triple potentially? Is this what kind of order of magnitude?
Potentially that can be. So that means that really the financial needs are very, very important.
OK, Bloomberg's Oliver Crooks speaking to EU Defence and Space Commissioner Andreas Kubilius about an hour ago, talking about the extensive needs to fund the shift around defence, particularly, of course, if the US pulls back and pulls back significantly. Let's stay on this topic then, because as the EU rushes to mobilise those billions for defence, venture capital funding in defence, security and resilience is at an all-time high. One fund, the NATO Innovation Fund, an independent venture capital firm, has released a new report that finds that Europe's emerging tech landscape is undergoing a significant transformation. Joining us now is Kelly Chen, who is a partner at the NATO Innovation Fund. Kelly, great to have you around the set. Thanks for joining. What are you seeing in terms of the private market, venture capital market commitment to fund defence? We know governments are stepping up. Is venture capital playing its role?
Absolutely. We published a report a few weeks ago with Dealberm talking about data from back at the end of 2024, so not even including the recent events in terms of our data. And we're showing that defense security resilience spending is at an all-time high, so north of $5 billion last year and growing 30% over the last 2 years, while the rest of the venture capital ecosystem has dipped in Europe.
Does that continue? Had the VC world seen what European leaders are seeing now? Had they foreseen some of this already? Or what are the catalysts going forward? How much more firepower is there to put to work? How much more cash is on the sidelines? How willing are LPs to put their money to play in the defence sector of Europe?
It's certainly a big question and something that's evolving as we're coming across the last couple of months. We're certainly hoping that there's a lot more private capital coming into this sector, as there's been government spending, there's been government grants for these deep tech startups. But what's most important in the coming future is large amounts of private capital coming to sustain the startups through their evolution.
Where is the money focused? What can Europe do? Where are the exciting technologies? What we've learned out of the Ukraine conflict is that warfare is different. How different? And does the technology in Europe exist to continue some of the trends that we've been seeing?
Right. So we're very much investing to maintain the technological edge of the nations in the alliance. So when we think about spending, it's in defense investing, but also it goes much broader than that. So we're investing across themes such as supply chain resiliency, sovereignty. We're thinking about health and biotech. We're thinking about new materials, critical minerals. So a wide swath of technology areas and industries that helps Europe maintain its technological edge.
In terms of the United States, if I back the United States out of this, how does the picture look different?
Yeah, so the U.S. has certainly been one of the largest in terms of VC spending in the broader deep tech space, so cutting-edge technologies. And we're seeing Europe rapidly growing on that front. So the U.S. has been the first to grow quickly. And right now we're seeing this 30% increase the last 2 years. And who knows what's going to happen after the last couple months. So with a lot of EU spending increasing the overall defense sector, we're going to see maintaining the technological edge, not just today, but 20, 50 years in the future is going to be very important.
Kelly, I know you don't speak for NATO more broadly. We'll go to Mark Rutte for that kind of conversation. But I just wonder, from your position, from the Innovation Fund, units of NATO, is it all business as usual, whilst the US is very vocal on its views on NATO and the world asks questions about whether NATO survives the next 5, 10, 15, 20 years, whatever? It's all business as usual, is it, or is it not?
For a fund like ours that's investing over a long-term horizon, so we're investing broadly in early-stage startups that'll take the next number of years to scale and grow their technology and adopt the technology into government. It is very much business as usual in terms of where we're looking to continue that long-term technological investing. However, there is a lot of opportunity today for example, defense startups to be adopted quickly into Ukraine. It's been one of the fastest innovation cycles out there. So it's a broad take advantage of today and see where we can help, but also think to the future.
And innovation in this field sounds exciting if you want to make sure that military forces are equipped. But in the very short term, perhaps the European story is more about a sort of scramble for much more traditional munitions and equipment. How quickly do these innovative solutions get to the front line? What do we learn from Ukraine on that front?
Sure. We're seeing startups in our portfolio that we've been around for about a year and a half now. They're already in Ukraine and they're supplying Ukraine. We have drone companies, we have on-the-ground autonomy companies. So there is the potential for adoption quite early, but we're looking to scale that adoption. 1 or 2 units doesn't make a difference. It's providing this at scale, thousands, tens of thousands.
Kelly, do European governments need to change the way they award contracts to the primes to allow those startups to get a bigger slice of the pie? Do they need to put in place a system to allocate greater funding to these startups and maybe reduce the role of those primes?
Right. So the way that spending is right now, a lot of those contracts, as you mentioned, are focused on the primes. And a lot of times right now, it's the primes that are adopting from the startups and then the governments that are buying from the primes. Yeah. So there's 2 routes here. I see the governments encouraging primes to encouraging more innovation from the primes to adopt from startups, or for governments to procure from startups themselves.
One nation that appears to have done this quite well is Israel. What can we learn from nations? Who does this well? Is it Israel? What can we learn in terms of the way that Europe needs to develop the ecosystem to bring new technology quickly to market, ultimately to the battlefield, to the resilience that Europe ultimately needs?
There's no perfect example right now. I come from the U.S. ecosystem, and there's been a lot of efforts to procure startups on that front with the DIU and see which branches of government are most interested in what kind of capabilities. And it's something that we're working on internally with our fund. So we have a chief adoption officer who runs a team who's looking at what are the biggest capabilities that governments within our LP landscape are looking at, and then what are the technologies that we can supply to fulfill those capability needs.
OK, Kelly, thank you very much. Thank you for joining us. Kelly Chen, a partner at the NATO Innovation Fund, certainly a theme we will continue to return to, the extent of private sector interest in VC interest in the defence startups, certainly something we will focus on as the year goes on. Let's get back to the markets here and now, though, and we are seeing something of a sell-off across European markets, no surprise, given we saw a sell-off stateside. A lot of nervousness around tariff policy seems to be one of the reasons for that. And we see some outperformance from chip stocks here in Europe, but some underperformance on luxury. So here's the luxury story, and a lot of this goes back to Ferragamo, one of those companies that's actually underperformed the sector over recent years. They reported a net loss for the full year. The numbers seem to be bigger than expected, that net loss bigger than expected, and that is weighing on the wider sector, as you can see.
OK, here's what else to be thinking about today, then. We are going to be watching 10 a.m. UK time, so counting down to this Eurozone GDP. Of course, the question marks about how the European economy transforms itself on that fiscal stimulus boost will be in focus in the months ahead. To what extent is there a bit of a floor being put under the European economy? That GDP data, of course, slightly backward-looking, but we'll break that for you. Anyway, the context will be there. 1:30 p.m. UK time, it is the data point of the day. Arguably, it's the US non-farm payrolls data. Expected print of about 160,000, though the whisper number, as Guy Johnson's been pointing out, is coming in much lower than that, as is the Bloomberg economics forecast. 5:30 p.m. UK time, the Fed's Jerome Powell will be speaking with. He'll touch on some of the softness we're seeing in the labour market of the US. Will be important as, of course, there is still continuing questions about how far the Fed can actually go in an environment of maybe slowing growth, maybe weaker consumer, and maybe slightly higher inflation as well.
And maybe cracks in the labour market. Yeah. That's what we'll focus on later on. And are we seeing those, or is it too early to see those? Is that a March phenomenon? Yeah. It's interesting, though, that often on days where we have non-farm payrolls, we spend a lot of the morning saying, well, investors are sitting on their hands. They're waiting to see what the payrolls data looks like. We've got a lot of volatility this morning. We've got a sell-off. That's anticipated because of where the US went yesterday. But looking at FX, we're getting sort of headline after headline. Dollar-yen falling 0.5%. We've got the euro at 0.6%. Another leg higher for the euro this morning. It's big moves.
Normally we'd wait. As Tom says, big data point, we'd wait for that. It's kind of payroll day in the USA. It's kind of, it's a day we all wait for, first Friday, as you say. But is the fact that it's kind of maybe in our peripheral vision, is there a danger lurking there? If we get a weak number, is this just another factor that could really spook markets once again? The fundamentals starting to show up in the data, which we've already been seeing weaken. The surprise index has been dropping rapidly. We are not at the weekend just yet. No, we have to get through payrolls.
Yeah, you were referencing some of the other weaknesses that we've seen in the labour market already this week.
So the Challenger survey that came out yesterday, which had a particular spotlight, of course, on federal workers who've been laid off as a result of Doge, but also the tech sector companies like Disney and others laying off significant number of workers, and retail as well. So at least in those areas, the softness is starting to come through.
And you pointed out Bloomberg Economics has a 65,000 call on this payrolls number, which is much lower than the street, which is at about...
Do I have to wait until the payroll number comes out before my weekend starts?
I think... I'm not sure. You make that call, Guy.
I think probably the answer is yes. I probably will just kind of pay a little bit of attention.
And talking of the weekend...
It is coming. I hear, rumour has it, after what has felt like an incredibly long week. We were talking about Lenin earlier on.
Yes,
and
there was a whole year in this week.
It does.
Not because of your socialist communist tendencies, but... historical references.
They're well known. No, it is my rugby tendencies that I think are going to be more to the forefront now. England have got a game on Sunday. I'm excited about that game, but I'm more excited about the France-Ireland game. We're playing Italy, but the France-Ireland game is the event, kind of lunchtime tomorrow, just after lunch tomorrow.
Why are you supporting France?
I'm not meant to be supporting France. I'm completely neutral in this game. But no, but if France beat Ireland, then the whole Six Nations gets thrown up in the air again, which is fantastic.
Adds excitement.
Excitement to the last few games. If Ireland win, then kind of Ireland are going to win.
Okay. I hear there's an Arsenal game, Tom.
We've got to beat Manchester United.
I'm saying that as if you've got something to add.
Because they're like 14th or 15th. France,
it's Liverpool's season.
Arsenal, I'm talking of France, because, of course, when Arsenal was at its greatest, it had a French leader. Doesn't anymore.
I spoke to him the other day.
Did you? Yeah. I know, he did. He put the odds on Arsenal winning the Premier League.
20%.
20%. It's maybe less than that now.
I would have thought it would be less than that now.
We're second, but Liverpool are storming ahead. So we had to beat Manchester United. Importantly, Liverpool have to lose, of course, to Southampton. But we did. Champions League, we're probably through to the quarterfinals. 7-1. 7-1 Arsenal.
Yeah, Salah comes off, Liverpool score.
Shall I say something about the Berlin Festival of Culture in case people think they're watching Sky Sports or something? This isn't. This is a market show. We'll be back to the markets shortly. The Pulse is up next. Have a good weekend, everybody. This is Bloomberg.